Okay, I think we're recording. Okay. Hi, everybody. I am here with Anna Mason from Rise with the Rest, and I'm going to let her introduce herself and tell you everything she can about her world of investing.
Hi, everyone. It's great to be with you and with Nina. My name is Anna Mason. I'm one of the investment partners at Revolution's Rise of the Rest seed fund. We're headquartered in Washington, D.C., and our fund, the Rise of the Rest Fund, is a $150 million early stage opportunities fund that invests in startups at the pre-seed, seed, and Series A stage, focused on investing in companies and entrepreneurs all across the country. Our very specific mandate is that we invest exclusively outside of Silicon Valley, New York City, and Boston. The headline for us is that 75 to 80% of the approximately $100 billion that gets invested into venture capital every year goes to just 3 states, California, New York, and Massachusetts. And our underlying thesis and really worldview is that we see opportunity through the lens of geography. And so what that means for us is that there are brilliant people building what can potentially be transformational businesses, literally located in cities all across the country, and they don't have the same access to capital, and by extension are not getting the same fair shake at really building those scalable, transformative businesses. So we focus exclusively on investing in places where most folks in venture capital aren't. My personal background, I've been in the working world for somewhere between a dozen and 15 years now. I lose track sometimes. I spent a long time in the first part of my career on Wall Street. I was actually a bond trader. I traded distressed, post-reorg private equity and high yield bonds and bank debt. So basically companies that had found themselves on the wrong side of the stick, either for corporate malfeasance or actually oftentimes really missing the mark on innovation. And I started my career at Lehman Brothers just before the crash, and then right into the crash when we ourselves found our company on that very unfortunate side of the continuum, and actually traded our own bonds and bank debt out of bankruptcy. And so that was a pretty transformational and seminal moment for me. I ended up staying on Wall Street for about 8 years. And the needle that I really like to thread, I think, between that beginning point in my career and now is that in many ways, venture capital actually represents the other side of these more distressed and high yield, high risk sides of the public market, which is that fundamentally in the venture capital space, we're still making very big bets that have binary outcomes. I think the critical difference, and what I think is most exciting and inspiring about it, is that in the venture capital space, you're fundamentally betting on optimists. And through the work that we do with Rise of the Rest, I think it's has proven to be, over the past 3.5 years that I've been at Revolution, just a really special opportunity to experience the country firsthand through the eyes of those entrepreneurs and the eyes of those optimists who are truly trying to reshape, transform, and reimagine what the future of not only their industries, but ultimately their cities can look like.
Anna, can you take a quick step back and just talk about what Rise of the Rest Tour is and how the fund came to be?
Yes. So Rise of the Rest sits within Revolution. Steve Case, who's most well known as the co-founder and CEO of AOL America Online, which launched and scaled 30 years ago or so in our own backyard here just outside DC, started Revolution back in 2005. He originally started it as his personal family office after his AOL exit. And that eventually transformed over the past close to 15 years into a traditional venture capital and investment firm. So if you fast forward to today, Revolution has approximately $1.5 billion in assets under management across a family of 3 funds. There's our early stage Rise of the Rest fund, there's Revolution Ventures and Revolution Growth. All told, throughout all 3 funds, we're investing anywhere from $100,000 to $1 million in our Rise the Rest fund, to $1 million to $10 million in our venture stage fund, to $10 to $50 million in our growth stage fund, and have many, I would say, pretty well-known companies across the different portfolios like Sweetgreen, DraftKings, Uptake, Tempest, StockX, Fiscal Note, and many others. The Rise of the Rest platform has a little bit of a different genesis within Revolution. So Rise of the Rest and our tours date back just exactly 5 years to the summer of 2014. And through a lot of the work that Steve was doing, when we're in DC, we oftentimes can get pulled into different policy-related opportunities. A couple of years prior to that, Steve had been appointed to a National Council on Entrepreneurship by then President Obama. And through that work, there was an effort in an organization called the Startup America Partnership that was launched. And at its core, what the Startup America Partnership tried to do was to think about ways to connect major businesses and corporations to startups and startup support community organizers. And that ultimately, the Startup America Partnership was rolled into Startup Weekend, which was then rolled up into and acquired by Techstars. But this foundational idea and experience and learning that came out of it from our end with Steve and Revolution was this idea that there was a real sea change and momentum shift in terms of what was starting to happen in regional communities all across the country, where it wasn't just Silicon Valley that really, was known as the epicenter for tech and innovation, but there were emerging startup hubs continuing to pop up all across the country. They weren't getting the same attention. They weren't getting the same capital. They weren't getting the same validation. And so back in 2014, this idea of investing in regional entrepreneurs and the fact that you didn't have to be located on a coast to start a business, we kind of codified that and formalized it and branded it around this idea of the Rise of the Rest. And our first effort at that, and we continue to do this today, it's the anchor of our Rise of the Rest platform, as we host an annual bus tour. We commandeer a presidential campaign tour bus, though what we do is not politically motivated in any way. And we go on a 5-city, 5-day road trip. It's about 60 hours of programming. We engage approximately 4,000 people across the 5 cities and communities that we end up in. And we do a series of both public and private programming events. And the goal there is threefold with each tour experience. We've now done 8 tours and been to just over 40 cities. First and foremost, we want to connect and convene with key local leaders and stakeholders, both from the public and private sector. Second, we really want to both experience, engage, and understand what's happening on the ground in each regional market. So there are certain similarities and trends that we see across markets, but there's also something really special we find that a lot of these cities just don't have, like a unique DNA to them almost. And so not coming in to be prescriptive, but really coming in to just engage and learn, and at a foundational level, just the power of really meeting people where they are is something that I think almost ironically we all don't do enough of in our uber digitally connected age that we live in right now. So we do a lot of on the ground engagement. And then the final component of the day is where we really focused in on our goals of celebrating, spotlighting, and validating regional entrepreneurship. And we do that through some public programming. So the arc of our day is that we kick off with a leadership breakfast for about 100 people. And that's where we bring together a plurality of perspectives, university presidents, CEOs from major corporations, the leadership from startup support organizations and startups and scale-ups, local elected officials, economic development authorities. And we really get a conversation going about what's happening, both the opportunities and the obstacles facing regional innovation and entrepreneurship. And a great byproduct of those experiences are actually that folks who are in the room there know of one another, but don't frequently get together and actually talk about these topics. So there's tremendous power just in convening these groups of people, and some very powerful partnerships have come out of that as a direct result of that. That middle part of the day around experiencing and engaging is where we'll visit half a dozen companies or organizations that can range from a startup accelerator all the way up through a pre or post IPO company. And we learn about what they do, and who the team is and why they're special and uniquely qualified, and why the technology or innovation is really bleeding edge. And then that last component of the day, the public programming, where we really want to spotlight and celebrate what's happening, we do that through an open forum, fireside chat discussion. And then we do a pitch competition where, in parallel to everything that we've done with the tour planning and engagement, we get a lot of folks on the ground. We get all the local startups to apply for a pitch competition. So we have, and this is maybe a good segue to talk more about investment. We have looked at a lot of deals and a lot of, not only a lot of startup applications. A quick note on our investment front, and then maybe we can chat a little bit about that process. Through our pitch competitions, we write $100,000 checks into companies. And the normal course of business in our regular investing, we do approximately 8 or so deals a quarter, which is, for basis of comparison, a very aggressive and fast clip of investing in the venture space. We'll invest between $250,000 and $1 million on our first check-in, and then we'll invest up to, we can invest up to $5 million in follow-on. A key component for us when we think about the stage at which we want to invest, we have really sharpened our pencils around what the entry point valuation is for a company that we're investing in. And where we've landed is that we try to invest in companies that have somewhere between a $5 and a $15 million pre-money valuation. So then you add on top of that whatever the round size is, and that gives you your post-money kind of fully baked valuation for the company. And then you say how much you're investing divided by the total amount invested, that gives you your percentage ownership. So the key for us, and this is true in venture in general, is that you need to be thoughtful not just about the stage at which you're investing and the valuation at which you're investing, but also the percentage of the company that you can own. And what you'll find is that a lot of investors, the reason why many investors will only lead is because they're trying to accumulate somewhere between a 20 and sometimes up to 30% ownership stake in a company. And that's because when you back into the math of what these companies can look like when they're really successful, because it is so hard and so few do ultimately achieve that true escape velocity and breakout potential. If you only own 0.5% of a company that ends up being worth $1 billion, you're not necessarily putting yourself in a position to return your investor capital, and return your fund is kind of the term of art that's used in the space.
That's awesome. That was a lot all at once.
That was a lot.
So what kind of, I know we're pretty short on time. So how involved are you guys with your investments, and sort of what's some general advice you could have for early stage founders as they're starting to approach the idea of raising a round?
Sure. So there are a couple things I'll point to. I'll get through them all as quickly as I can. The first is relationship build. So a lot of founders put a lot of time into thinking about how they're going to market and how they're going to sell to their customers. You should be taking the exact same approach or a version of it when you think about how you want to effectively sell to your investors, because it can be a similar type of relationship. And actually, if you do it right, it's a longer term relationship. So you have to think about your marketing funnel and cultivating in the same way. Oftentimes people will say asking for advice is the best way to raise money. There's actually a lot of truth to that. It's very, very rare in the industry that you walk into a meeting with your proverbial handout and walk out with a check. So much of the industry, in particular at the earliest stages of investing, is all about you want to have a high level view on the market that the company is trying to operate in. Is it interesting? Is it on an upswing or a downshift? And do you think that the pie is as big as it could possibly get, or is what the company is suggesting actually going to just take market share from others or make the pie bigger for everyone else? So you want to have a view on the market, you want to have a view on the technology, but critically important is you want to have a view on the team. And everyone talks about that, and it kind of sounds hokey, and it's kind of an annoying answer. But from a practical standpoint, in terms of the building blocks to actually get yourself funded, you have to think about how you are being presented to an investor. So being able to get really great third-party references for how you get introduced. Even if you can find an investor's email on LinkedIn, it's pretty brutal, but like, don't reach out to them on LinkedIn. Figure out who you know in common and go through that. You want to figure out, if you publish on Medium or on another blog, you want to be able to demonstrate that you're a thought leader in the space. So it's one thing to walk into a meeting and give your opinion. It's another thing to say, oh, and please read my Medium post that received, 500 claps, and everyone else thinks that, I'm an expert on this space too. Those types of signals can be really, really useful and really impactful. You will also find in the diligence process, even at the earliest stages, that investors will want to talk to references. The most common reference check is going to be a customer reference check. And so you want to actually be thoughtful, one, about your customer's time, right? Because you're still in a financial relationship with them too. But you want to also coach some of the customers that you tee up for investor calls, so that and a very quick Google search will reveal what common diligence questions calls are. You want to be able to seed them. I've taken so many customer diligence calls where the customer has actually put me off so much that it's made me think that the company I'm looking at doesn't necessarily have a high quality of customer, which makes me question the overall business model. From a deal docs and deal terms standpoint, I think one of the critical components to think through around fundraising at any stage, but in particular at the early stage, is that nearly all investors in our industry do not lead deals. They follow in deals and they participate in syndicates. So there's a bit of like game theory in terms of how you want to try to set up your round. You want to try to get a bit committed first. So say like 20% of your round committed. And then you want to really identify your lead. So they know that there's interest. They know that they're not, sort of coming into this solo because you've already got 20% spoken for, but there's still enough out there that if they wanted to take a really large position as the lead, they could do that. But ideally your lead should probably be somewhere between 25 to 50% of your round. And then the balance is where you can go out and you want to try to strategically build a strong syndicate with 2 or 3 other institutional investors. There are a lot of free resources out there that I think are under promoted in the space that can help founders better understand deal math, convertible note math, safe math, and 2 resources I would point people to. One is called Cooley Go. Cooley is one of the larger law firms across the country who represent startups. Cooley Go is an awesome free resource that most people don't, that I think doesn't get promoted enough. And another is actually some great tools and widgets that you can play around with and plug in some scenario math to off of a website called the Long-Term Stock Exchange. And I forget what the name of the exact tools are, but they have some really great tools there for convertible notes and then looking at note conversion for where you raise your next rounds. So it's worth reading up on and doing your homework about. And related to that, and this is tricky at the early stage because legal fees can add up. But when you have lawyers who are maybe like family office lawyers or personal attorneys, and you kind of suck them into this world of venture docs and company formation docs, it will cost you more money in the long term to have to unwind that. And you will almost always have to unwind that. Some last few very random, like fun facts to think about. Institutional investors do not like to invest in common equity. They want to focus on preferred equity. So thinking about how your convertible note gets structured, institutional investors are going to want to see it convert into preferred, not into common, for protection down the line. And there's similar, things to take into consideration from a tax formation, whether or not you want to be an LLC or a C Corp. Most institutional funds won't invest in S Corps. So just knowing that when you go into your process, I think can help inform how you set up and structure a company.
That is awesome. Well, I have you for one more minute. What's one of your portfolio companies you're really excited about right now?
We have 130 companies.
I know. Just pick one.
Let me share two briefly. Okay. That will give you, I think, maybe a bit of a sense of the scope of the types of investments we make. Or I'll give you three very quick examples. So one is based out of Raleigh, North Carolina, and it's called Prion. And it's built by the team that actually built the foundational technology for Alexa. Their company was acquired by Amazon back in 2011. They then, after a stint at IBM building out Watson, came back to the startup market and are essentially building an Alexa for enterprise. So their big bet is that we are increasingly moving, for a variety of reasons, towards a future where audio and spoken content will become a lot more prevalent and will start to dominate corporate communication and information sharing. So it's a really interesting AI-driven data ingestion engine that then lets you kind of talk to your computer, talk to your mobile phone, and ask them for information from a company meeting or a colleague or things like that. I'm really excited about that technology. In St. Louis, Missouri, we have a direct-to-consumer swimwear and travel wear company, and you might kind of scratch your head going, how did that end up in a venture portfolio? But I think in this day and age, with how ubiquitous technology is, and how relatively inexpensive the streamlining of that application has become relative to 15 or 20 years ago, any great business in any industry right now, if they really have a chance at scaling meaningfully, is a technology business somewhere in its core. And this company, Somersault, is just that. So they launched with just doing women's swimwear with eco-friendly recycled materials that were 4 to 5x stronger than what was out there in the market, coming in at a sub-$100 price point, which is almost unheard of in the space. And their foundational technology is actually that all their suits are crafted off of 1.5 million bodies for 10,000 women. And so they literally have the perfect fit, which is a big deal when you're effectively wearing undergarments as bathing suits outside. And they have just seen rocket ship growth, raise their Series A 6 months after they raised their seed. Wow. And are just kind of taking that DTC market by storm.
Yeah.
And then the last one is in the logistics space. It's a B2B same day delivery service for the things like paint supplies, HVACs, plastic printing materials. And so the idea there, logistics space is fascinating right now. And it's sort of how are you trying to build a business within the Amazon ecosystem or support companies that have had to rejigger the way that they operate because of the reality of Amazon and the consumer expectations that have been created. So that's a really interesting play that scales based on launching in tons of different markets and building out a technology that connects an Uber-like fleet of drivers to these businesses who can, you've got a handyman at your home or your business repainting, the kitchen and runs out of paint. The consumer now expects that paint to be there in an hour because Amazon has created that expectation. So it's interesting to think about the derivative and extended applications of, kind of the major tech players in the space.
That's awesome. Thank you so much for taking so much time to chat with us. I wish you could be here in person.
Thank you for having me. Thank you for having me.
Yeah. Next time you're back in Denver, we'll actually have to have you come in person.
I would love that. I would love that. Thanks so much, everyone. Have a great
Thanks,
day.
Anna. Okay,
Bye.
bye.